Charlie Munger sold half of his BABA position. Paul, you own $1 million of the stock. Are you scared? What's going on?
So when we met with Mohnish Pabrai back in December, he made a very, very specific statement.
I love this.
Yes, it was great. He said, investors will sell for 1,000 reasons and buy for only one.
This never crossed my mind. I just thought selling is fear. But when you say it, you're right. Maybe maybe you out there are paying for college. Maybe you want to buy a car. It's finally to cash in. You're taking profits.
Well, what's the one reason they buy?
I got you.
To make money. Mm-hmm. So I don't know why Charlie Munger sold his BABA, but I can speculate. Okay. Remember one thing. He didn't sell the entire position. And it's kind of interesting that Charlie Munger and Warren Buffett believe in long-term and the stock falls a lot. So one of two things happened. He looked back and said, you know what? I got the analysis wrong. But if that's the case, why only sell half? If he truly believed he got the analysis wrong, he would have sold the entire thing.
This is lightning to my brain, Paul, because you're right. I never thought about that.
Well, yeah, absolutely. I mean, listen, guys, they have no problem being highly concentrated in one investment. Munger and Buffett always talk about, for the average person, diversification is very important. But if you're a very, very astute investor who has a thorough understanding of a company or investment, you should be very, very concentrated. So what's my speculation? My speculation is BABA fell a lot. He had other investments in a strong market that went up a lot that he wanted to sell. This might be what's called a tax loss harvest.
Tell me.
Which is actually also the reason why Mohnish Pabrai sold his BABA position.
In December, right.
So what is a tax loss harvest? A tax loss harvest is you have two investments. Company A you invested in, and it went up 100%. So you want to sell it. You're like, you know what? This has reached its max. I want to sell it. Well, guess what? You have a capital gain. And let's say you made $1,000 on it in profit. So you have to pay tax on $1,000. But you have company B. Company B has fallen by 50%. And you have $1,000 loss. If you sell both of these, you get zero tax liability. You made 1,000, you write off 1,000, it's zero. Now, you might sit there and say, yeah, but I lost the investment I really like. Unless you find a similar investment that has the same credentials, right? So what this means is if you have another company, company C, that has all the attributes of company B, the same kind of upside, et cetera, you could sell this one, pay zero in tax, and still buy a company that gets you the same type of investment return that you want out of company B. Now, this might sound complicated, and I get that, but it's a good way, and a lot of great investors use this as a way of foregoing taxes and taking advantage of some tax losses now to offset gains that have already been realized as well. And that's why I believe he did that, because if you think about it, it was one of his biggest holdings and he sold it still. And my speculation is because he probably had some gains along the way that he sold off as well. And in order to not pay taxes, he said, you know what? If I sell half my position, I don't pay taxes on my other gains, and I still have some Alibaba stock, and I can use that money to go buy something else. I did it recently with my SPY versus QQQ sale. I had a big loss in SPY. I sold it and shorted QQQ. So I'm going to get all that tax write-off on my SPY gains against my other gains, SPY loss against my other gains, and still own QQQ as a short, which has done fabulously well.
Did it ever cross your mind to sell your BABA last?
No, and the reason being is, so then goes the next question. Has my thesis changed on BABA?
That's where I'm going with this, sure.
I keep looking at the numbers, and I keep looking at the situation. Here's the question. This VIE structure, which was a big thing 6 or 7 months ago, and now you never hear about it. If all of a sudden China withdraws all their companies from the U.S., or the U.S. bans Chinese companies from being publicly traded here, I've already called Merrill Lynch. Mo has already called Charles Schwab. And their exact comment was, your stock would be converted to the Hong Kong exchange. And the only risk you have is if you want to sell it someday, it might take a couple of weeks for that money after you sell it to come to you. That's it. That's it. So the next question becomes, do I believe in Alibaba? Well, 1, do I think it's selling cheap today relative to value? Yes. 2, do I think that Alibaba will be a bigger company 10 years from now than today? Yes. Revenue will be higher. 3, do I believe they will have more profit 10 years from now than today? Yes. And guess what? They're buying shares back now at a cheap price. So they're now giving me an incentive to keep my shares because they're decreasing the number of shares out there to give me more ownership of the company. I still believe in this company. As you guys know from our software here, if I go to Baba and I click on it, I look at all the data on it, and I think to myself, darn, this is a company that made, look at its history, guys. Look at its max history. It went public around $100 back in 2014. It's at $100 today. But look at the income, the revenue. In 2014, it did $8.24 billion in revenue. It's doing $112 billion today, 13 times more. Guess what? It has more in profit today, 3 times more in profit today than it did back then in revenue. So it did $8.24 billion in revenue, and now it's doing $23 billion in profit today. This is incredible, and the stock is the same price. Think about that for a second.
When I reflect on this, Paul, obviously when someone of this magnitude sells, as a normal younger investor than you with not as much experience, I get a little shaky in my boots, and I have to remind myself what you've told us is that if I liked it enough to buy it the first time, and the numbers keep getting better,
or staying the same,
I can rest easy knowing I made a good decision. I am almost forced to make this decision because the numbers are so good as a value investor.
And it is scary that Charlie Munger sold half his position. Don't get me wrong. When I heard it, I was like, oh, well, what I'd heard was somebody mentioned it to me. Paul, did you hear Munger sold his position in Baba? I was like, wow, really? And then I went and Googled it, and he sold half his position. Still a lot. But if he didn't believe in the company, he wouldn't even keep any of the shares. It really, the second I saw he sold half, I said, tax loss harvest. I don't know if that's true or not, but it immediately triggered to me that that's a possibility.
So Paul, again, you got to help me as a new investor. Show me in our proprietary software why we like the valuation of this company, why we like this company, why we're buying it.
So we have our 8-pillar process, right? So the first thing we look at is the market cap. That's not one of the 8 pillars, but it's the first start. This is if you bought all the shares outstanding. The first pillar is the 5-year PE. This takes the 5-year of net income and divides it into the market cap. We want it to be under 22.5. It's 16.3. Second pillar, we want the return on invested capital greater than 9%. Seth,
wow,
it's 10.5%.
That's good.
They do a good job of reinvesting the capital that's invested in the business. Pillar number 3, we want revenue growth over the last 5 years. So we just go to the income statement, 24.85 to $112 billion. That is a 5 times growth almost. Pillar number 4, net income growth. Look at this, Uncle Seth. 6.86 to 23.6. Massive growth.
Jeez. Pillar
number 5, it's the hard one people understand. We want shares outstanding decreasing. We go 5 years ago, actually the 6 mark, 2.46 to 2.7. That's an X there. So they are increasing their shares outstanding. But again, they did announce that they're decreasing shares by buying more shares back. So this number will continue to decrease. Okay? Pillar number 6, debt is very important in a company. So what I found is I want to find companies that are good at generating cash flow and they can pay off their debt very quickly. So what I did was I took the 5-year average free cash flow. So if you go back to this main page, our 5-year average free cash flow has been about $20 billion. We want to multiply by 5. So we basically want less than $100 billion in long-term liabilities. Very simple. So we go to the balance sheet, we go to the bottom, and we go to total long-term liabilities, $37 billion. Guys, that means if they do 2 years of free cash flow, they can pay it off. 2 years of their average of the last 5 years. They're doing $23 billion a year. This is less than 2 years they're paying off their debt. This company can stick around then. Now, obviously, the last 2 pillars have to do with our free cash flow. Free cash flow is the lifeblood of the company. You can do one of 5 things with it. You guys know what they are: pay down debt, buy back shares, pay dividends, reinvest back in yourself, or make acquisitions. So we go right here. As you guys all know, we added the line here, $10.25 billion to $30 billion. Massive check. Guys, this is a 7-pillar company, I think, because look at the 5-year average free cash flow, 18.4. We multiply it by 20 to get a market cap that we want to pay for the company. That is $368 billion. If you remember,
273 was the current cap.
So guys, look at this. So on this 8-pillar tab, guys, it's 7 check marks. Now, obviously, it doesn't mean you go out and buy it immediately, but I love the story. I love everything about it. Again, we're trying to teach a process here. We're not telling you just to mimic our investments, but I do own Baba, and I plan on owning it for a while. I'm hoping for a very long time, but right now I look at the company as it goes down in price, I want to own more of it.
Yeah, that's it. Thanks, Paul. Watch this next video on our 8-pillar process. See you.